Hi, all. Thank you for joining us on Free Float. I am Sham and I have Kishan with me.
Yes. Hi everyone.
Hey, so last episode we discussed how the markets just keep rallying in spite of us being in the middle of a pandemic, and it puts investors in a fix, right? Should they invest now? Should they wait for a correction? And if they do invest now, what is the worst case scenario, right? So what happens if there's a second wave? What happens if this thing goes on, if we can't discover a vaccine? There's so many possibilities, and we encounter these questions every day. And honestly, the thing is, nobody knows, right? We just can't predict what will happen in the future, and least of all, we can't predict what will happen, in the markets, because the markets have a mind of their own. And people try to explain what the market did after the fact, right? So there's this old adage which says, the news follows the market, right? So at 3:30, after the market closes, that's when you can sit and spout some theories about why the market went up or down or sideways, and then come up with some sort of logic behind it. But during the market, nobody really knows what the hell is going on, across the board. So it just does what it does. um, so, um, so a lot of first-time investors, well, it's one thing, if you've been investing for, a few years, that okay, you'll kind of internalize this and say that, look, I get what I get out of the market. But if you're a first-time investor, the problem is, it leads to a lot of analysis paralysis, right? You don't know what to do, and the literature online is, it's full of jargon, right? I think you wrote a bit about buy high. I mean, sorry, buy low, buy low, sell high. And like the minute you go talk to someone, he'll be like, dude, value investing, momentum, and then growth investing. You have to buy companies that are growing, man. What do you do with some mining company in Aurangabad, like whatever, right? So um, and then you have all these guys coming in and saying, you should go with this brand name manager. He's this guy who he went to IIT IIM, and he's got his MBA from blah blah blah. So he can't go wrong. But the thing is, if you talk to 20 different people, you're going to get 20 different opinions. And the funny thing is, they all have the ability to be right and wrong at the same time. So it all depends on your time horizon, right? So some guys, the whole problem with predicting the market and recommending something, as an investment, is that on a long enough timeline, if you're directionally right, you're going to be fine. But in the short term, a lot of things can happen, and that's pretty much what we discussed during our first episode, which is the sequence of return risk. So in the long enough time horizons, markets go up, so you're going to be fine overall. But in the 5 or 10 year period in which you're trying to save for a particular goal, save for buying a house, or sending your kids to college, and so on and so forth, you're going to face this situation where bad things happen one after the other. And just like how positive returns compound, so do negative returns. So you end up with suboptimal outcomes during your holding period. So the question really is, we touched upon active versus passive, and there's no secret where we fall, in that spectrum, right? I think, I don't think you are a big fan of passive investing, Kishan. Is that right?
Yeah, I mean, for me, I like action. So I mean, I like I like things to do. I mean, the thing that you were talking about, I mean, the thing about I mean, it's not just first time investors, right? Even like professional managers feel the pressure because for them, their performance is measured by, most managers, compare their performance. I mean, the bosses or even the clients or even the general public, compares their performance with, say, the benchmark, right? So, if you have a portfolio which is even underperforming for a short period of time, they suddenly feel the pressure that they need to, outperform. So you might have a strategy that they worked for a long time, and they're very convinced, right? But then but if the market is telling them something else, or if even for a short period of time, the pressure that they feel from outside is a lot for them to suddenly change their strategy, or be forced to do something that they would not like to do. And the thing comes back to is that no one can predict what the market will do today or tomorrow, or say like even a year from now. No one can tell you. People get in this thing that in the, 12 months nifty target is 13,000, or and I always wonder, I mean, if I've never done this exercise, but I'm sure no one's got it right, because there's a beautiful chart. In fact, I should try to find it and put it on the blog this week, where if someone tells them, an astrologer told them that the market will be 30,500, most people would not believe it, right? But if somebody comes on the same basis as 30,500, suddenly that has more credibility. I mean, it's the same thing, I mean, in fact, the astrologer might be, or a monkey might be right, as equal chances of predicting whether the market will go up or down tomorrow. I mean, they have got so. I'm not so I. But what I believe is that whether it's value investing or growth, but the idea is to be for you to buy something that is it's something that you believe in, like a product or a service that you like or you believe in, that it's a well-known company, and buying at a reasonable price, it's a good investment, I would think. It's the whole adage. It's not like you should buy something that's really cheap, dirt cheap, because the problem becomes you might be buying a company is cheap for a reason, right?
Right.
It's much more easier for you to buy something. When you say buy high, it could also mean buy high and sell higher, or something that you can just hold on for a long period of time and have comfortable holding it, because it will generate returns. And if a company is growing at a reasonable pace, then the stock will keep up with it. I truly believe in that. And it should not matter whether the market is for most people, they would get frightened, right? And that's when the thing about managing those risks come in play. I think if you're 25 years old, and you have, say, 40 years of like investment period, you can take up 50% hit on your portfolio. But if 55 or 60 years old, then and you're looking at retirement, or when these things matter a lot more, you just cannot afford to take 50% hit. Forget the financial thing; just the stress, will have harmful effects on your health, right? I mean,
Right.
and so I believe in active management, especially in those times when people do not, cannot afford to take, major hits on their portfolio, because it's just very stressful, And I truly believe that, this thing about holding, like, the market, like people say, stocks always go up in the long run, like everyone says that. And I don't believe that, because if you see any other, like, most people say the US, all right, and US is a truly an outlier
No,
in like,
I completely agree with that. The US is a complete outlier. In fact, other than some three markets, in this whole world, US, Switzerland, and I think there's one more market. This whole buy and hold forever work only in these three markets.
yeah,
And that is because like the market doesn't exist in an island by itself, right? It's
yeah,
interconnected to what's going on in the country. It's interconnected to the political economy, how the politics within that country play out, and how they prioritize things, right?
right.
So
And
most of the guys, who keep believing in this passive, the so-called boggleheads and all that stuff. I completely agree. In the sense that their sampling period, and the country that they have sampled, that thing has worked out, right? So they can call it evidence-based investing if you only look at evidence of the US markets,
Yeah.
right?
Yeah.
But the minute you enlarge the evidence, to kind of cover the whole world, you'll realize that the US is completely different compared to every other country. And if you look at the way the political economy has worked out, since Reagan, right? So since 1980s, the pendulum has completely swung in favor of capital, right? Labor unions are completely smashed out of the picture. Tax cuts, tax cuts, tax cuts. And then the whole embrace of China to kind of give like a artificial boost to productivity, at home. Keep wages low, keep prices low. It's really, they kind of managed to sort of direct the whole country into consuming everything now versus saving something for retirement and so on and so forth. So it's certainly mind-boggling when you speak, when you look at how the whole thought process has changed. Like how some of the people thought about saving and investment in the 1950s, even in the US, right? It's
Yeah.
completely different from the way people think about saving and investing now. And everything, about investing now is about, momentum investing, or, like let's make money as soon as possible. And also, forget about saving. Like the money that they create is already consumed, right? It's already
Right.
promised to somebody else. So the whole thing is different, and you can't take that and generalize to the rest of the world, and certainly not
Right.
in, in emerging markets where inflation is a huge risk. We don't quite control our own monetary policy like how the US does. So there are like so many different things going on, in emerging markets that I don't think truly passive investing is even advisable. But having said all that, the problem really is for first-time investors, right? Like you said, if you're 25 years old, you just got a job, and you're looking to save like 5 grand or 10 grand every month in the market, then filling your head up with jargon is mostly counterproductive, right? So the best thing to do, when you're just starting out, is to just enter the markets, buy a couple of ETFs, 2 or 3 ETFs that has the ability to kind of keep you in the market by not scaring you off, right? So markets have a way of diving 30-40%, probably every other year. So I think for first time investors, the best thing to do is get used to the market's behavior, right? Get used to the fact that shit happens. Get used to how you feel, as an investor, looking at your statement at the end of the month, right? Like kind of know thyself, right?
Right.
So do that first before you get into this whole hair splitting arguments about growth, value, momentum, and that kind of stuff. And the same thing applies to mutual funds as well. So which mutual fund is the best? Nobody knows, right? Even the manager can't guarantee that he'll outperform next year, or for the next 3 years or whatever, right? So if the manager can't do it, then the guys recommending it surely can't do it. So it's basically saying, okay, from an asset allocation point of view, what makes sense to you, and just hoping that after costs that follow, that manager or the mutual fund can keep up with the indices, right? So that is your base case scenario. So given this, yeah, it is best that first time investors waste as little time as possible trying to figure out which is the best strategy, which is the best mutual fund, who is the best advisor, and just go for a basket of ETFs that he can do like a monthly SIP or something like that, 5-10 grand, so that he gets used to the whole idea of saving, gets used to the whole idea of understanding that markets can fluctuate quite wildly, and understanding himself, right? So I think that would be the best way for people to get started, irrespective of this pandemic, or irrespective of what who is the president of the US or who is the prime minister of India. It doesn't matter, just get started today.
Yeah, I mean, I think that's a good point because the most important thing here is to invest. Pick a reasonably good fund, or like an ETF that you said, and just to get started. And once you get started, I mean, over a period of time, you'll also understand more about what's happening. What are the factors of influence, and you'll also realize things that matter, are not, the noise, if you just listen to noise, you would, do things that you need not do, right? You would probably try to time the market, you might exit, you might get, worried. But over a period of time, you would understand that, markets go through different cycles, and you would end up still, I mean, earning a decent return, right? And what we would advise people to do is to have a portfolio, which we actually should talk about sometime next week, or in the future, where you should invest based on who you are, So if you have someone who's, who has the ability to take more risk, then your portfolio should be structured in a way where you're taking more risk. Not risk as in, you blindly go invest in a bunch of junk stocks, but invest in maybe in companies, or in a portfolio which is more aggressive. But if you don't have the ability to take more risk, then you should probably try to manage. The idea should be that this equity gives you that slight kick in your portfolio, like slight appreciation in portfolio, but a large portfolio is more conservative, like it's more balanced towards your preferences. And I think that's a very important point, because you can invest, everyone would like to have more money, right? I mean, if you ask more, but the idea is that you should not try to risk what's important to you, trying to get that. I think that part of investing, no one in CNBC and stuff talks about it, that, you should, when someone says, oh, should you buy the stock? It always comes back to the, whether the stock is good or not. No one asks the question, okay, what's the opportunity cost for you to, is there something else that you can, deploy this money to? Do you need this money for some particular reason in the next 5 years? No one asks those questions. Those are more important than, is this stock, was it not? I mean, I've seen people, who say that, people who sold their Infosys at 2000, and before it really very rocketed, they're like, oh, you should have held it. But you don't know what the person's financial circumstances were at that point, and no one knew at that point Infosys. I mean, no one knew Infosys would be that way. And even if they knew, they would have probably, if you believe in time in the market, you probably sold it at some high, triple top or double top or something like that. You would have gone and sold it at that thing. So it's very easy to do this all in hindsight, but people should invest based on what the preferences are, their personal preferences, and what the risk objective. And I completely understand. Agree with you. So we have actually put up a strategy this week, like a live thing where it's very interesting, because it like invests 30% in Nifty, 30% in mid cap stocks, and 40% into bonds. So the idea is that you have the basic market return, which is what the Nifty will provide, and the mid caps over a long period of time, because there's more risk, has provided more return also. If you take the last 20 years, it has outperformed Nifty by a considerable margin. And a bond is basically to provide stability to the portfolio, to to limit the drawdowns of the risk that the client is taking, so that they don't get affected when the market really falls. This would provide the balance, and the idea is that sasomeone starts investing to this strategy, because it would give them a good start. They're just starting to invest, that is.
Right. So do check out the strategy. I think it's up on Small Case. It's live on Small Case. So go out there. We've included a link, in the newsletter. If you're a first-time investor trying to get started, this is probably the best way, to just do it. And once you have a decent corpus built up, and you're looking to take on more risk or take less risk or so on and so forth, at that point do reach out to us, and we are here to help you out. Kishan, thank you for your time, and thank you guys for spending your weekend watching us. So we will catch you again next weekend on Free Flow. Bye.
Yeah. Bye.